Hey guys, Victor here with Individual Investor. So far, we have discussed three financial ratios that incorporate debt in order to evaluate the financial health of a company. These are the debt to equity ratio, the current ratio, and the working capital. What I want to do now is to discuss another ratio that helps us determine the ability of a company to repay its financial obligations based on earnings. This is called the debt to EBITDA ratio. Debt to EBITDA ratio is a figure that is primarily used by lenders to evaluate if a company is in a good position to repay its debt and any potential new loans. This is very similar to bank loans. When you apply for a loan through your bank, they will ask you about your annual income, your monthly or fixed expenses, your existing debt, etc. Because at the end of the day, they want to know if you have enough earnings to repay that loan that you are applying for. The formula is self-explanatory. You simply take the debt and divide it by the EBITDA, and that gives you the debt to EBITDA ratio. For this example, I will continue to use Facebook just like I did in my EBITDA and enterprise value to EBITDA videos. If you haven't watched those videos, please go ahead and review them and then come back. So here I have some screenshots from Facebook's 10K form, which is what we use in the previous videos. So we have the balance sheet, the income statement, and the cash flows over here at the bottom. So the first thing we gotta do is figure out the total debt. And Facebook turns out that they don't have long-term debt, so the only debt that they have is actually the debt from the operating lease liabilities, the current lease liabilities, and the non-current lease liabilities that I have here highlighted in red in the balance sheet. So let's just add those up. 1.023 billion plus 9.631. Perfect. So we have $10.65 billion in total debt. That's it. For EBITDA, we're going to need the operating income, and then we need to add the depreciation and amortization. So the operating income, that's in the statement of income. Here we have it in the second screenshot. You can see here again inside the red box the income from operations. That's $32.671. So that's 32.671. Perfect. And then depreciation and amortization, that's in the statement of cash flows. So if we scroll down here in the last screenshot, we see here depreciation and amortization, and that's 6.862. So 6.862. Perfect. And now EBITDA will be equal to the operating income plus depreciation and amortization. And perfect. That gives us a total of $39.533 billion in EBITDA. And then finally, all we have to do here is divide the total debt by the EBITDA. And there we go. We get a debt to EBITDA ratio of 0.3. As you can see, the debt to EBITDA ratio for Facebook is very small, 0.3. This means that Facebook doesn't have any issues at all in terms of paying off their debt and financial obligations given the EBITDA that they generate. It is also important to compare the debt to EBITDA ratio over multiple periods of time. Ideally, you want to see the debt to EBITDA ratio decrease over time or at least remain flat or constant. If the debt to EBITDA ratio increases period after period, this could mean that the company is either borrowing more money or that the EBITDA is decreasing over time. And to wrap this up, normal ratios range from 3 to 10 in normal circumstances. But as always, please remember to always benchmark your ratios with industry standards. Thank you so much guys for joining. Please leave any questions, comments in the section below. And if you can like and subscribe to my channel, I will be very, very grateful. Thank you for joining, and I'll see you next time.